Good morning, everybody. I make it 9:30. Welcome to our business life cycle series on succession, exit planning, and wind up. Just to let you know that this is being recorded and it will be sent out to you afterwards. My name is Beth Ann Evans, and I'm a partner in our business recovery and advisory team. I spend my time advising boards on their duties and providing advice to mitigate risk and loss. I plan formal strategies to assist businesses in maximising value, continuing to trade, or winding up. Later on in the session, I will give you some more food for thought when it comes to formal winding up. From time to time, people reconsider and reevaluate not only their business, but their lifestyle and retirement options. Over recent years, some businesses have sadly struggled while others have flourished. For many different reasons, people are considering their options for exiting their current businesses, and we're often asked about the best way to do this. So in this webinar, we explore some of the options available, including succession to family members, employees or management, a third-party sale, or a liquidation or winding up of a company. We plan to make this webinar as interactive as possible and give you an opportunity to ask questions to the panel. We have some pre-registered questions, but please do use the chat function to post your questions as the webinar progresses. We will do our best to answer these at the end of the session, and where we can't get to all of the questions, we will pick up with you afterwards. As with previous webinars, we're looking to try and keep this to 45 minutes, depending on questions. So without further ado, I will hand over to my colleagues to introduce themselves. Over to you, Pete.
Thanks, Beth. So I'm Pete Mills. I'm a director in our business tax team, and I specialise in particular in advising on the tax implications and tax structuring of corporate reconstructions, as well as buying and selling businesses. And finally, we have Kevin on the panel with us.
Thanks, Pete and Beth. I'm Kevin Paget. I'm a director in the corporate finance team at Menzies. So basically, I advise business owners on acquisitions and disposals, and management teams on acquisitions, basically project managing the whole transaction, raising the financing where needed, and taking it all the way through to completion.
Thanks, Kevin. Over to you, Pete.
Thanks, Beth. And Kevin. So before we get into any of the detail, just as a bit of an overview, the diagram on the screen summarises some of the types of strategies that are often most relevant for succession planning, which broadly reflects a bit of an agenda for this webinar. So firstly, we'll be looking at some strategies that might be relevant for internal succession. Then Kevin's going to talk about the prospect of selling to an external buyer. And in some cases, those strategies either just might not be feasible or might not be desirable for whatever reason. So a final way to exit a business is for this to potentially be wound up, which Beth will talk about a bit about at the end. Before I go on, we are conscious that there is some ongoing commentary at the moment in the media about possible changes to certain taxes, in particular capital gains tax is still a bit of a hot topic. And it's a little bit unfortunate that the timing of this webinar has sort of so unhelpfully coincided with the recent change in government. We also had a question in advance about what those changes might be and the possible timing. And the honest answer is that it's still very difficult to predict both what changes might materialize, if any, and over what timetable. So, excuse me, the commentary in this webinar is based on current rules, what we do know, or what we suspect. And I would expect that a lot of the strategies and considerations that we'll talk about will continue to be relevant anyway, at least to some extent. But it's just something to bear in mind, that there may be changes that should just be kept under ongoing review. Can we get the next slide, please, Beth? So with that sort of general comment out the way, the first thing I'm going to talk about is some of the possible options and considerations when it comes to internal succession. One common model for this is for ownership of a business to be transferred to employees. For example, if there are a select group of employees, perhaps within the senior management team, who have the appetite, experience to run a business themselves going forwards. There are some simple options that we can potentially use to achieve this. For example, shares can simply be given away to those individuals. And in some cases, that can work well. Although, excuse me, one of the obvious issues with this is that it doesn't provide a mechanism immediately to compensate the former shareholders, which is often quite a key consideration for those individuals on the other side of the transaction. It's also important to note that there are some tax issues associated with this, in particular that employees are subject to income tax if they pay less for shares in a company than those shares are worth. So even if employees don't have to pay the full value for shares, there's still a cost to them, potentially in terms of tax. A gift of shares is also strictly still a disposal for capital gains tax purposes, so tax charges can potentially still be arising to the former shareholders as well. Albeit quite often there are reliefs that might be available to mitigate some of those particular tax charges, particularly if the business is trading. So as an alternative to that, employees could be asked to pay for the shares directly, which again can work in some cases, but there are still some natural barriers with that approach. First and foremost, that employees just simply might not have access to the funds they need to acquire a business. Or they might be reluctant to take on the risk associated with committing their own capital, borrowing personally to achieve that. Just for completeness, there are some share schemes that can be used to bridge some of those gaps to some extent, albeit those don't tend to work to facilitate fundamental changes in ownership, and so aren't really part of the scope of this webinar. Share buybacks are also a tool that we quite commonly see working reasonably well as a way to facilitate the exit of one of a wider group of shareholders. But again, those don't work as a strategy to get new shares into anyone else's hands. And there are also some legal, some tax issues that can sometimes be relevant and make that approach less desirable than some other alternatives that we might have available. Can we get the next slide, please? So with that all together in mind, there are some other structures that we quite often look at to allow for ownership to transfer to a new group of shareholders, whilst allowing still for the former shareholders to fully realise the value of their shares. And one of the most relevant ways that we use to achieve this is to structure a share acquisition through a new holding company. So in essence, the way this process works slightly differently is that the next generation of shareholder essentially set up a new company. In the diagram on the screen, that's Holdco. And that new company then acquires the shares from the former shareholders for consideration that's either payable immediately or can be deferred and paid over time. Whilst this naturally is a bit more complicated, the mechanical process of this provides a much higher degree of flexibility then, particularly in terms of how the shares can be paid for and how risk is borne by the various parties. Can we get the next slide again, please? So, as opposed to in a direct acquisition of shares by an individual where they would need to fund any acquisition themselves, the holding company in that structure can pay for the shares in a number of different ways. That could include any combination really of money that is being invested directly by the new shareholders, but also cash that's already accumulated in the business can potentially be used, or consideration can be left outstanding and paid out of the future profits of the group. The holding company can also still raise external finance to pay some or all of the purchase price, and that can potentially be a bit easier as well, both because a lender can take security against the assets of the business, and also because the new shareholders don't then necessarily have to borrow themselves, so don't take on the same level of personal risk as they would if they were to do so. That possibly leads reasonably nicely onto one of the questions that we had in advance of the webinar, which was about what the most tax efficient way to extract cash from a business is. And the simple answer to that, certainly at the moment, is that it's generally preferable to sell shares in a company with cash still in the business. I know Kevin's going to talk a bit in a minute about how companies are valued, but the share value would normally reflect any surplus cash within the company. And so selling the shares essentially allows for this to be received by the shareholders, but as a capital gain. By contrast to if this was taken as income, as salary, as dividends, etc., the current rates of tax for which are much higher. So as I sort of briefly alluded, the acquisition structure that we're talking about here potentially allows for this to happen because in essence, once the holding company has bought the existing business, the cash that was already in there can be used to pay whatever is owed to the former shareholders. So a couple of points on the tax position. The former shareholders in this case should still be subject to capital gains tax on any proceeds they receive generally. And as I said, at the moment, that's still preferable to receiving income. But also, if any of the purchase price is being deferred, for example, to make the transaction a bit more easier for all the parties to afford, it's generally also possible to structure this type of transaction so that the tax can be deferred as well, such that it would only become payable when the money's actually received. Historically, that hasn't necessarily been particularly attractive, but if there are changes to tax rates in the future, for example, it might potentially become more relevant. So I've so far talked to this point about internal succession principally in the context of employees. But just for the avoidance of doubt, a lot of these principles and options do also apply if the intention is that shares might transfer to, I don't know, younger generations of the shareholders' families, rather than or as well as to employees. There can actually be potentially a bit more flexibility in those circumstances because some of those income tax rules are referred to when employees are acquiring shares, they don't necessarily apply to transfers within a family, but there are still capital gains tax, inheritance tax implications, etc., that might still be relevant. So quite commonly, we still see the acquisition structure that I've referred to here can still be relevant in the context of family transactions. And actually particularly in the context of non-trading businesses, property investment businesses and that sort of thing. So on that note, I'm going to hand back over to Kevin, I think, who's going to talk a bit about some of the practical issues associated with succession planning and how to approach a buyout process.
Thanks, Pete. If you could change a slide, please. There we go. So often a management buyout is overlooked by a business owner as an exit route, but it can actually work really well in many instances. So I'm going to run through some of the key considerations of a management buyout, or as it's often shortened, an MBO, and look at some of the advantages and disadvantages of selling a business to the management team. So regarding the advantages, management buyout can be a great way for the business owner to reward the management team. Businesses are generally only as good as the people running and working within them. So what better way for a business owner to reward the senior management team who have basically helped get the business where it is today than giving them the opportunity to buy the business and for them to have the opportunity to potentially make a significant capital gain in the future. From the owner's point of view, not only does an MBO reward the staff, but it's also a process that can be controlled by the owner. If an owner plans to sell their business to a trade buyer in a number of years' time to match their envisaged retirement date, what happens if the market is flat at that time, or if a buyer can't be found, or if the right price and terms can't be agreed? the owner may not be able to exit and retire as they had planned. With a management buyout, as long as a fair and reasonable price is agreed, an MBO can usually be completed irrespective, to an extent, of factors in the outside world. The structure and terms of the transaction are also more controllable than with an MBO than a trade sale. For example, with an MBO, the owner could choose to reduce their involvement gradually over time and support the business post-completion, which may be important to the owner, and especially when there's deferred consideration at stake and needed to be paid from future profits. The business owner may not be able to dictate such terms if the business is sold to a trade buyer. So there's commercial risk. The sales to the management team will generally avoid the commercial risk of word getting out in the market that the business is for sale. Even with non-disclosure agreements in place, rumours can spread quickly. News of the business being sold could be commercially sensitive and affect trading. It could potentially unsettle a customer who may be about to sign a new contract. And if employees find out, they may get concerned about their job security and their future. With a management buyout, word is less likely to get out to the market until after the transaction is completed and a formal announcement has been made. And in my experience, management buyouts are generally well received by the customer base. The owner may not feel comfortable disclosing confidential and commercially sensitive information, such as customers, contract terms, employee data, etc., to a trade buyer during the due diligence process. I will need to consider whether they would want the prospective buyer that could be a competitor to have gleaned such information if the transaction didn't complete. However, there's very little commercial risk when selling to the management team, as they generally already know this information. Also, as the management team already work in the business, the warranties and indemnities given by the seller to the buyer are often a lot less extensive than they would be when selling to a third-party trade buyer. A trade buyer will need to have a higher level of legal protection, as they don't have the insight into the business that a management team would have. For a management buyout, it's generally the case that the legal agreement is a bit simpler and with less risk for the seller of there being any potential clawback of the consideration paid. Business owners very often don't consider a management buyout as an exit option on the basis that the management team don't have the money to buy the business. However, there are numerous debt and equity providers in the market that have cash available and are solely looking to back management teams on these kind of transactions. So as long as the management team can stump up what the funders call hurt money, which is typically a reasonably material amount of money that someone wouldn't want to lose in comparison to their wealth, funders would always require some investment from a management team, so they feel there is some alignment of risk sharing. Ideally, the fund would want to see some fresh cash come into the transaction, but they will also consider an equity rollover of shares or share options. So look at the disadvantages. An MBO may not always achieve the same exit value for the seller at a trade sale. An MBO can offer a fair and reasonable price based on a multiple of the existing maintainable profits, but quite often a trade buyer will have a strategic reason for the acquisition, such as the business complementing their own service or product offering, along with synergies and economies of scale. Where a buyer has a strategic fit, it typically means that the buying company will be able to make higher profits than the existing standalone profits made by the target company pre-completion. This can enable the buyer to pay a higher strategic price to the business than what a management team may be able to pay. The marketing of the business for sale may uncover not one, but hopefully a number of strategic buyers, all keen to acquire the company. In this situation, the corporate finance advisor's role will be to drive up the offers in a competitive bidding process. This competitive bidding environment and obtaining a premium price is obviously difficult to achieve if the business is simply sold to the management team. Often with a growing business that has rapidly increasing profitability, a trade buyer will structure a transaction with an earn-out. Basically, it's further consideration paid if profit targets are achieved in the future. The business owner will typically stay in the business for a year or two after completion to ensure the earn-out is achieved, to ultimately increase the overall consideration they receive for selling the business. With an MBO, whilst there can be flexibility to the structure, it's typical that the vendor leaves the business and the management team take over the running of the business, not really giving any opportunity for the seller to increase the consideration they receive through an earn-out. For management buyers that are too small for private equity firms to be interested, or where the management team want to hold all the shares, the financing is often a mixture of external debt raised and vendor deferral. In this scenario, the cash the owner receives on completion will be limited to what funding can be raised in the debt markets. Debt funding is typically leveraged against the fixed and current assets of the business, or as a small multiple against the operating profit and cash generated by the business. It's very common that the full consideration wouldn't be payable to the seller on completion of the transaction, and any deferred consideration owed to the seller would need to be paid out of future profitability of the company or from a further fundraising in subsequent years. With various professional advisors, including corporate finance, tax advice, due diligence, and corporate solicitors for both the management team and the funders, the professional fees can rack up into several hundreds of thousands of pounds. These costs are typically billed to the management team's new company that is set up to buy the trading company. The size of these combined fees will cut into the money available on completion to pay the seller and can often make smaller transactions financially unviable. Also, MBOs can be very time consuming, and a typical management buyout could take around 6 to 9 months to complete. The last point to consider is the owner having confidence in the management team, as it's likely there will be an element of deferred consideration to be paid, and the owner is only likely to receive this if the management team are capable of maintaining the business profitability post-completion. So in summary, a management buyout is definitely something that should be considered as an exit route when selling a business. And we at Menzies will run a feasibility assessment at the outset to assess whether this is a viable option for a business owner looking to sell their business. So on that basis, I'll pass you back to Pete, who will talk about employee ownership trusts.
Thank you, Kevin. Yeah, so the options and the buyout structure and the management buyout concept that Kevin and I have both been describing up until now works principally on the premise that there's a select group of individuals who are going to acquire the company. And another structure for internal succession, though, and one that I think it's fair to say is becoming increasingly popular, is what's called an employee ownership trust. And that is essentially a specific type of vehicle, a trust, which is established to acquire a controlling interest in a company on behalf of all of the employees. So for those not familiar with the concept of trusts, essentially this involves a group of trustees who legally own the shares. That tends to be 3 or 5 people, but they have to hold the shares for the benefit of a wider group of employees. In this context, that's the employees. Generally speaking, in an EOT, the purchase price is then financed by the company through making contributions to the trust, and that's either out of the existing cash reserves, future profits over time, albeit there do seem to be an increasing number of lenders as well who seem open to financing employee ownership transactions, at least to some extent. But as Kevin said, in the context of MBOs, pure debt finance, I think, tends to be based on a much lower multiple than generally applies to the whole company value. So there are some limitations to that extent. Can we get the next slide, please, Beth? Thank you. So, as I said, this is becoming a more popular model for succession, and I do think it does work well in certain circumstances. In particular, if there isn't a specific group of employees who can or want to acquire the business, but where shareholders might still be concerned about the legacy of a business if it was sold to a third party, or if they want to provide security for or just reward employees sort of as a whole. It's also a bit more dynamic than some of the other structures, because once the trust is in place, that doesn't result in any specific individuals owning shares. And so essentially that ownership structure will adapt and evolve to whoever the employees are at any time. There are also some pretty generous tax reliefs that currently apply in respect of disposals to an EOT. And the most significant of those is that disposals to a qualifying employee ownership trust are essentially tax-free for the selling shareholders. I think even with the possibility that there may be tax changes on the horizon, given this particular relief is designed to encourage employee ownership, my personal view on this is that I think I'd be quite surprised if this was substantially limited, whatever else might change. And so this tax relief may become potentially even more attractive, relatively speaking, going forwards, I think as well. There are some limitations with this process, though, that I think it's worth noting. And in particular, I think probably the main one is how the payment process works. Because an EOT is funded principally out of the cash and future profits of the business, practically that limits how quickly selling shareholders can get paid. The company also needs to be able to operate after the EOT is put in place, and so there need to be appropriate governance processes, a robust management structure, and that sort of thing. And Kevin alluded to sort of it being really important that a group of shareholders have confidence in the management team when they're selling in an MBO. That is equally as important in an EOT transaction, if not more important, because those individuals aren't actually shareholders. So they don't necessarily have the same sort of personal upside and incentives that they might have had in an MBO as well. Finally, there are some conditions that need to be met in order for the tax reliefs to apply, including that the company must be trading, the trust must be for the benefit of all employees, and the trust needs to acquire a controlling interest in the company. That said, even if those conditions aren't immediately met, it can sometimes be possible to restructure existing arrangements to possibly achieve a better outcome. For example, we quite commonly see businesses like partnerships and LLPs, which aren't automatically within the scope of these rules, can potentially look at incorporating in advance. And similarly, if a business has trading and non-trading activities or multiple trades with different dynamics, different objectives, it's generally possible to separate those so that the relevant parts can potentially be sold into an EOT if that's relevant. So altogether, that hopefully gives a bit of a flavour of some of the options and tools and considerations that might be relevant for planning for internal succession. And I'm now going to hand back over to Kevin, who's going to talk about how companies are valued and trade sales.
Thank you, Pete. So yeah, I'm going to talk through some very kind of basic valuation metrics. Typically, owner-managed businesses are valued on a multiple, what's called the maintainable EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. And effectively, it represents the cash generation of the business from operating activities. Whilst profits achieved in previous years will be taken into consideration, it's generally the current maintainable level of EBITDA that is typically used for evaluation. So not what you did last year, not what you're going to do, but kind of what you're able to do and maintain now. So once you've got that figure, adjustments then made to this maintainable EBITDA figure to effectively normalise the profits and make them comparable to other businesses. For example, most owner-managed businesses are run, let's say, tax effectively for the business owner who may not take a full PAYE market rate salary, and instead it's typical that they may be remunerated with a minimal PAYE salary and the bulk paid as dividends. So adjustments are made to the maintainable EBITDA to reflect market rate salaries for the owners and normalise the profits. Another common adjustment would be to reflect a market rent where the property is owned personally by the shareholders, by the owners, and no rent is charged to the business. So that would be adjusted for as well. And then if there's one-off non-recurring costs, such as a large bad debt, a large recruitment cost for a senior hire, some redundancies, or maybe even some corporate finance fees, these should be added back to derive an adjusted maintainable EBITDA figure, to which a multiple is then applied. So my work is I've shown maintainable EBITDA of 200k, made adjustments of 50k to arrive an adjusted maintainable EBITDA of 250k. Now, multiples. These are very arbitrary and are dependent on numerous factors, but are typically centered around profit and risk. From a business owner's perspective, the mantra is profit up and risk down. So generally speaking, bigger businesses command higher multiples as there is generally more substance and they are generally perceived as having less risk. Certain sectors such as cybersecurity or AI may command higher multiples as these markets are less developed and there is perceived to be more growth opportunity than there is for traditional well-established markets. So in my example, I'm using a multiple of 4 times in the slide, simply because that's a figure which most business owners may begin to consider a sale, or what a sensible multiple on a sale price. So having to multiply the adjusted maintainable EBITDA by the multiple, we get to what is called the enterprise value. However, the enterprise value isn't the amount that the shareholder would necessarily receive in their bank account, as further adjustments need to be taken into account, such as the excess cash held in the business above what's required for working capital, and any debt owed also needs to be considered. Buyers wish to be left with sufficient working capital to run the business post-completion. They don't want to have to be dipping into their pockets to put more money in. So the enterprise value is adjusted for the cash holding, less any debt, which apart from obvious debt such as bank loans may include things like accrued bonuses and corporation tax up to the point of completion. An adjustment up or down to reflect movement between the actual working capital at completion compared to the historic average is then applied. And for simplicity, in my example, I've assumed there's no movement in the working capital here. So adjusting the enterprise value for cash, take away the debt, and the working capital movement gets you to the equity value, which is the value the shareholders will receive in their bank accounts, excluding any professional fees. Next slide, please. So I'm going to talk about a few things to consider in preparation for a sale. As mentioned earlier, profits up and risk down are the 2 elements that business owners should be thinking about before they begin the sale process, and how they can improve or mitigate in both these areas. Every business is different, and a strategic review of the business can assist to improve the maintainable profitability prior to sale. This process should really be considered 2 or 3 years before embarking on a sale, if possible, in order to help maximise the proceeds. On the risk side, if the business has a high customer or supplier concentration, this can be perceived as risk with all eggs in one basket issue, and may reduce the multiple a buyer wishes to pay. If the owner is still very hands-on and integral to the business, it's going to be very difficult for a buyer to let the owner walk away without reflecting the risk of doing so by proposing a lower multiple. Corporate governance, records, reports, budgets, forecasts, and board minutes are often considered a reflection of how well the business is run and controlled. And with these in place, whilst it won't necessarily help push the selling price up, it will give confidence to the buyer that the business is well managed and controlled and should help keep the transaction on track. Sometimes a seller looks to prepare what's called vendor due diligence, where an impartial, independent is prepared by an external third party that demonstrates to a potential buyer the strengths and weaknesses in the business. Next slide, please. So then it comes to finding a buyer. And now you get to this part of the process. There are 3 things to consider when it comes to finding a buyer. It's common to prepare an information memorandum in advance. The memorandum is a factual selling document that reflects the business in the best light and should provide the answers to all the questions a buyer would typically ask during the first round of questions, such as what does the company do? What's its services and products? The historic and forecast financials, the organisation chart, customer concentration, reasons for sale, etc. Producing and sharing an information memorandum with prospective buyers is far more efficient than having various ad hoc phone calls with different interested parties, and it ensures everyone has seen or heard the same information. Every sale that we work on at Menzies is off-market. We use a variety of databases and research tools to identify a long list of potential buyers. This is whittled down to a short list of typically 12 to 20 companies that we think would be an ideal fit and have the credentials to make the acquisition. The shortlist is agreed with the seller, and these prospective buyers are contacted on a no-names basis until a non-disclosure agreement is in place. There is no for sale sign hoisted in the public domain, and only those companies that sign the NDA will be aware of the proposed sale. Whilst putting together a shortlist of potential buyers, we conduct our own buyer due diligence as to whether the buyer is capable of making the acquisition, and we review any past acquisition history they may have. So the graphic on the right of the slide shows what our buyer research team will consider when scouring the market to find potential buyers. They will look at industry competitors, overseas buyers looking to acquire in the UK, buyers with a potential strategic fit, such as businesses in a vertical supply chain, companies selling complementary products and services, PE-backed businesses looking for bolt-on acquisitions, and if we put all these together, we should hopefully be able to drive a competitive bidding situation to maximise the value for the sellers. So I'll now pass you back to Pete, who would talk about the sales structure and optimising the business structure for sale.
Thank you, Kevin. Again, yeah, so a final consideration when it comes to selling a business, in addition to, I think, sort of maximizing the underlying value of the company, is making sure that the sales structure then is set up optimally, to minimize the amount of tax payable in that process, ultimately then leaving as much money in the seller's hands as possible, to do whatever they want to or need to with that. So the table on the left-hand side of the screen illustrates broadly how there are differences in the tax treatment, and in particular in the type and timing of taxes, depending on how a sale is structured in different types of ways. So for example, if a shareholder sells shares in a company or a business themselves, the proceeds accrued directly to them. They'll generally be subject to capital gains tax, the current rate of which at the moment is up to 20%. And the key thing to note then about that particular process is that because the cash is received directly by the former owner, they then have complete control over how to use that. Alternatively, if a company is part of a group structure, shares in a subsidiary can be sold. In that situation, the parent company will be subject to corporation tax on the disposal, but there is an exemption for some disposals of shares in trading companies, which can be quite attractive, particularly if the intention is that the proceeds arising from that process will be reinvested in other business activities, because in essence, that initial sale can potentially take place with no immediate tax charge, leaving 100% of the proceeds available for that purpose. That said, additional tax charges would then arise if the shareholders were to extract the proceeds, which might end up more expensive overall, particularly if that has to be by way of dividends or income. So finally, if a company sells its business as opposed to shares in a subsidiary, corporation tax will also generally be payable, but there aren't any reliefs that would apply. So that's normally an immediate tax charge of up to 25%. And then there would be additional tax charges if the funds need to be extracted. So it's very rare that that particular setup will be particularly ideal from the seller's perspective. So the long short of all of that is really that there are often various options available, as well as, I think it's fair to say, some clear pitfalls. And also, again, in the context of there possibly being changes in tax rates going forward, I think it'll potentially be even more important to make sure that all of these options are critically looked at and weighed up, depending on what rates do go up, if any, and also the extent to which certain different reliefs might be changed in the future. There are also a couple of notable examples where some pre-sale planning can be particularly advantageous from a tax perspective, in anticipation of a sale. As was sort of alluded in that final example, having to sell a business out of a company is generally the worst possible outcome from a tax perspective, but there are sometimes ways that process can be re-engineered to achieve a better outcome if we have enough opportunity to plan. And another example is if a business has non-trading assets, which can either affect eligibility for certain reliefs, or in some cases can prevent a sale of a whole structure or particular parts of a structure. In that case, separating those different assets and activities can sometimes be beneficial to provide at least more flexibility. And similarly, if a business has multiple business units or different divisions, there can sometimes be benefits to splitting those up in anticipation of a sale so that those can be sold separately or at different times. In general terms, I think with all of these things, having a good run up and the opportunity to plan and reflect for a possible exit is important to make sure that there's time to actually pursue any opportunities that are there to optimize the position, both from a tax perspective, but also, as Kevin said earlier, in terms of some of the commercial considerations as well. So that's all of our content on sales planning. And so on that note, I'm going to hand over to Bethan, who's going to talk about winding companies up and how that works as a possible exit route.
Thanks, Pete. You'll be pleased to hear that I don't have very many slides, so I won't keep you too long. But I thought I would run through quickly a scenario where you maybe have sold the business or sold part of the business, and you've got a company left, and you don't have any need for that company any longer. So you may want to look to wind it up. It's ceased to trade. There's no further trade in it. This is very much driven by the shareholders. It's a decision of the shareholders. And the key is solvency, because the directors have to swear a declaration of solvency to say that they are of the opinion that the debts and liabilities are going to be settled within 12 months. And appended to that declaration is a statement of the company's assets and liabilities. Now, as you can see on the slide, it's a special resolution of the shareholders. You need at least 75% of your shareholders to vote to wind up the company, and the shareholders also need to have an insolvency practitioner, a licensed insolvency practitioner, who is willing to act as the liquidator of the company in order to deal with the winding up, to deal with the assets, and to pay any liabilities if indeed there are any. So it all depends really when you're winding up a company, and whether you're doing this via a solvent liquidation and members voluntary liquidation. It all depends on values, the values for distribution, because dissolution might be an option rather than a formal liquidation. I would just point out here that it is an offence to strike off a company if it has liabilities. And you need to consider contingent liabilities there as well. I'd point out as well that it's an offence to make a false declaration of solvency. So again, this sort of goes back to what Pete was saying as well, and Kevin, about planning. Planning is key, and you need to really consider all of the different angles that you have in the company. Consider your risk, and consider collaboration between your accountants, your tax advisors, potentially solicitors, and your insolvency practitioner. And bringing in your insolvency practitioner early can help facilitate that collaboration and that planning exercise, because they can point you in the direction of the advice that you may not realise that you need, that you may need, and help to manage that risk for you, and ultimately get funds distributed to you in a tax efficient way. So considerations, I've already mentioned that declaration of solvency and the fact that you don't want to make a false declaration. So it's really important to think about what the assets are, that are in there, but also what are those liabilities? What are the contingent liabilities? What are the things that you maybe haven't thought about? Bear in mind that if you have liabilities when the company goes into solvent liquidation, those liabilities will accrue statutory interest from the date of liquidation, and that is 8%. So you don't want to be having any liabilities on that declaration of solvency at the point of liquidation if you can help it, because that's going to increase your costs. Indeed, there are going to be times when you do, but looking to pay them as quickly as possible in the liquidation is really important. Think about contingent liabilities. Think about warranties and guarantees. Are there any warranties that have been provided or guarantees that have been provided on products or services? Think about any sale and purchase agreements, any clauses in there that might need to be considered. Have you given any guarantees in those documents, or are there any clauses that say you can't wind up the company within a specific period of time? That may need to be thought about, and conversations may need to happen, and that may involve your solicitors as well. Think about non-cash assets. Are there any other assets that need to be dealt with as well as cash? Maybe they haven't been turned into cash yet and they still need to be sold, or maybe they need to be distributed in their form, in their current form, distributed in specie. If that's the case, we need to think about values and the tax implications around that. So that goes back to tax planning and making sure that there's an adequate strategy and an adequate plan in place prior to pressing the button on the liquidation. Another one that's not on my slide, but often goes under the radar and is not thought about these days, is the pension. What's going to happen with the company pension if it's still in the company? It may have been transferred, but if it hasn't, what's going to happen? It needs to be wound up as well, and there are cost implications of that. That can be managed, but if it's not thought about and planned for, it can add to your cost. So I told you I'd be quick, and I also promised that we'd try and keep it to 45 minutes. So we've got a poll for you, if you'd like to. Have a little look at that. And if there's anything that you'd like to hear any more about, tick one of those boxes. You can tick more than one, I think, as well. And we can get back to you and provide you with a little bit more information. I'm not sure if we've got any questions as well.
Yeah, there's one question in the chat. Oh, there's the poll results. Okay. Good mix of responses there. We try to answer the pre-registered questions in our presentations between the three of us. But there's one question in the chat at the moment coming from Brian. It says Entrepreneurs Relief 2024, please advise. So Pete, I'm going to pass this one to you.
I was bracing myself for a question like this. I assume the context of that question is whether it's expected that there might be any changes to that particular relief this year, which to an extent I tried to preempt with my initial preamble, but I appreciate I didn't get into any of the specifics. I think, to be honest, as with capital gains tax generally, it is very difficult to predict what might happen to what is now business asset disposal relief, formerly entrepreneurs relief. There's been talk in tax media for years and years and years about further changes to that, and I know also within the government there've been talks about it as well. So I have heard rumours that there could be some further restrictions to that, which may be announced at the budget coming up this autumn, albeit that is still fairly speculative. And I do also think it's potentially important to note that actually as a tax relief as a whole, business asset disposal relief doesn't really cost the Treasury a great deal. Now that the lifetime limit has been reduced to £1 million, it's not a significant amount of the tax take that's being lost because of that relief. So, yeah, it's difficult to tell, but it is possible that that could be subject to change, and hopefully we'll have some more visibility as we approach the budget in the next few months.
Thanks, Pete. There's no more questions in chat, so hopefully this has been informative for everybody. Who would have thought selling a business or exit planning would be so complicated? So, but the three of us is what we do. You're great at running your business, but I think the key takeaway is if you're considering exit planning, succession planning, talk to one of us in the first instance, because we will help to maximize the proceeds that you'll end up receiving. Thank you, everybody, for attending, and our contact details are on this slide.